Greetings, and welcome to this expert-level report on the significant market events from the last 24 hours. While global indices mostly ended the day higher, the true story isn't one of frenzied trading or unexpected catalysts. Instead, it is a narrative of measured optimism, with investors positioning themselves ahead of a crucial macroeconomic event that could fundamentally alter the course of monetary policy. The market, in essence, spent the day quietly preparing for a confession, a long overdue revision of the U.S. labor market's health that many suspect has been overstated for months. This report will break down the day's action, starting with a comprehensive scorecard of global market performance. We will then dive deep into the central event, the highly anticipated Bureau of Labor Statistics benchmark revision, and explain its profound implications for the Federal Reserve's policy trajectory. From there, we will pivot to the geopolitical stage, connecting President Trump's tariff policies to a strategic response from global trading blocs like BRICS, and examining why some political turmoil failed to move markets. Finally, we will conclude with an analysis of the cryptocurrency market, demonstrating its increasing integration into the broader macroeconomic framework. The Global Market Scorecard. Monday's trading session saw a continuation of positive momentum across global equities, though the gains were more of a quiet drift than a confident surge. Investors appeared to be holding their breath, awaiting a key data release. North American indices, nudging towards new highs. In the United States, all major indices closed in positive territory, with the tech-heavy Nasdaq Composite leading the way to a new record high. The S&P 500 added 0.2% to close at 6,495, just shy of its own recent record. The Dow Jones Industrial Average rose by 0.3%, ending the day at 45,514.95, while the Nasdaq Composite climbed 0.5% to reach 21,798.70. The Russell 2000 index of smaller companies also contributed to the broad market advance, rising 0.2% to 2,394.89. Contributing to the S&P 500's performance was the news that AppLovin and Robinhood markets are set to join the index later this month. Robinhood, in particular, has seen its shares triple in 2025, driven by the ongoing boom in digital asset trading and surging retail interest. The company's inclusion highlights the growing influence of the cryptocurrency sector on traditional financial markets. European and Asian markets, a mixed picture. European stocks largely outperformed their US and UK counterparts. The DAX 40 in Frankfurt closed 0.9% higher, ending at 23,807.13 points, while the CAC 40 in Paris also gained 0.9%. In London, the FTSE 100 managed only a more modest increase of 0.1%, closing at 9,221 points. Asian markets, however, presented a more varied picture. Japan's Nikkei 225 closed lower, shedding 0.42% to finish at 43,459.29 points. In contrast, the Hang Seng Index in Hong Kong rose 0.9% to close at 25,634, extending its gains for a second consecutive session amid improved market sentiment. This divergence underscores the regional factors at play, even as global macro themes dominate the overall narrative. Currency and commodity moves. The US dollar faced continued selling pressure against the euro. The EUR-USD pair, a key indicator of global currency sentiment, rose 0.18% to 1.1740. This appreciation of the euro is tied directly to the macroeconomic developments unfolding in the US and Europe, a point we will explore in detail shortly. One of the most notable moves of the day was the continued surge in gold prices. The yellow metal jumped to a new record high of $3,644.14 an ounce, its value having been driven by a confluence of factors, including speculation of future Federal Reserve rate cuts and creeping fears of stagflation. Gold has now gained nearly 40% year-to-date, with its performance reflecting a growing concern among investors that central banks will not be able to keep pace with inflation. The macroeconomic catalyst, the BLS benchmark revision. The central event of the day, though it may not have generated headline-grabbing market volatility, was the preliminary benchmark revision from the U.S. Bureau of Labor Statistics, BLS. This is a critical process where the BLS updates its monthly payroll estimates with more accurate and comprehensive data derived from state unemployment insurance records, which cover over 95% of U.S. jobs. The purpose is to correct for discrepancies in the monthly survey data and provide a more reliable picture of the labor market's health. The numbers tell a new story. Economists widely predicted a significant downward revision to non-farm payrolls for the 12-month period ending in March 2025. Consensus estimates from economists at Comerica Bank, Wells Fargo, and Evercore ISI suggested a downward revision of between 470,000 and 1 million jobs. To put this in perspective, this is a major downward adjustment. It means that the U.S. economy was not adding an average of 149,000 jobs per month as previously reported, but rather a much softer 88,000 to 110,000. The magnitude of this expected revision is similar to the unusually large downward revision of 598,000 jobs from the previous year. This updated data confirms what many analysts had suspected. The labor market has been cooling at an even faster pace than the monthly numbers have indicated. The causal link to the Federal Reserve. The market's quiet optimism on a day of generally uneventful trading can be directly traced to the implications of this data revision. The Federal Reserve's policy decisions are, by its own admission, data-dependent. A major downward revision to job numbers provides explicit justification for a dovish shift in monetary policy. The process is straightforward. The benchmark revision provides a clearer, more reliable look at the labor market's health. The data shows a significantly weaker labor market that has cooled at a much faster pace than previously thought. This softening is a clear signal that the economy may be slowing and could therefore not only tolerate, but may also require, a looser monetary policy. As a result, this new data opens the door for a more dovish stance from the Fed and could give some of the central bank's more accommodating members a reason to argue for a larger than expected rate cut at the upcoming September meeting. The market is already moving on this premonition, and the quiet upward movement in indices and gold prices reflects this conviction. The political undercurrents. Beyond the raw numbers, the BLS benchmark revision is unfolding within a charged political context. The previous month's significant downward revisions to May and June jobs data prompted President Trump to fire the BLS commissioner, with accusations of faking the employment data. The National Association for Business Economics felt it necessary to issue a public statement urging the defense of the BLS's accuracy and independence. This ongoing political friction is more than just a footnote. It represents a deeper struggle over the fundamental integrity of the data that underpins all policy and market decisions. The expected downward revision of payrolls through March 2025 further fuels this debate. While the market's focus is on what the numbers mean for Fed policy, the political reaction highlights a broader tension between institutions and political power, a dynamic that can create uncertainty and friction even if it does not immediately impact asset prices. Geopolitical forces and economic implications. While the U.S. labor market dominated the macroeconomic conversation, two key geopolitical events provided contrasting examples of how global and local forces intersect. Trump's tariffs on South Africa, a quantifiable economic blow. President Trump's decision to impose a 30% tariff on South African goods has delivered a direct and quantifiable economic shock to the nation. The South African Reserve Bank projects that in a worst-case scenario, the country's gross domestic product could decline by 0.69% this year, a forecast that also accounts for a potential 15% depreciation of the rand against the US dollar. The tariffs have also put an estimated 30,000 jobs at immediate risk in export-dependent sectors such as agriculture and automotive assembly. This is particularly damaging for South Africa, an economy that has struggled to achieve more than 1% growth for 2 consecutive years and has seen its global economic competitiveness ranking plummet from 37th to 64th place in the past 2 years. The BRICS strategic response. The economic turmoil created by these tariffs provides a direct backdrop for the remarks made by the Indian External Affairs Minister, EAM, at the recent BRICS virtual summit. While the EAM's comments did not explicitly address the South Africa tariffs, they offered a powerful strategic response to the kind of protectionist risks exemplified by the U.S. policy. The EAM's speech called for a more stable and predictable environment for trade and investment, one that is fair, transparent and to everyone's benefit. He advocated for the democratization of manufacturing and production, and the creation of more resilient, reliable, redundant and shorter supply chains, to proof the international economic system against such shocks. The EAM's remarks were not merely abstract platitudes, they were a direct, forward-looking strategic prescription for the exact problem South Africa is facing. This connection demonstrates how high-level political rhetoric from a multilateral summit is a strategic response to specific, market-impacting actions by other global powers. The BRICS bloc, in this view, is positioning itself as an alternative to a global order that appears increasingly prone to unilateral trade measures. European political jitters, a non-event for the markets. In contrast to the clear economic impact of the tariffs, the political turmoil in Europe barely registered with investors. France's Prime Minister, François Bayrou, was expected to lose a no-confidence vote, a significant political event that would normally cause market instability. However, the DAX and CAC 40 still rose, with European stocks outperforming their UK counterparts. This muted reaction confirms that the dominant global macroeconomic narrative, centered on the Fed's potential policy shift, is currently a more powerful driver of sentiment than regional political instability. The fact that investors prioritize the prospect of a more dovish U.S. central bank over a major political crisis in one of Europe's largest economies reveals a key pattern in modern markets. Major, systemically important events can often overwhelm and overshadow regional political events, at least in the short term. The maturing crypto market. The cryptocurrency market is no longer a fringe asset class. Its movements are increasingly synchronized with the same macroeconomic forces that drive traditional markets. This was evident in the price action of the day's leading digital assets. Price action, a tug of war at key levels. Bitcoin traded steadily around the $112,000 mark, showing a modest gain of 0.97% over the past 24 hours, but was unable to break through key resistance near the $113,000 level. Meanwhile, Ethereum traded around $4,300, up 0.30% over the last 24 hours. The overall cryptocurrency market capitalization remained robust, standing at around $3.87 trillion. The same macro winds that move equities. The primary drivers of this stability are identical to those influencing traditional assets like equities and gold. Analysts point to three key factors: the hope of U.S. rate cuts, fresh liquidity flowing through stablecoins, and continued institutional buying. A downward revision to inflation data could trigger a rally, pushing Bitcoin above its current resistance level. The movements in the crypto market are fundamentally linked to the same Federal Reserve policy expectations that are dictating the mood of traditional finance. This is a critical point that underscores the market's increasing integration. The irreversible mainstreaming of crypto. Beyond daily price movements, today's news confirms that the cryptocurrency market is becoming a central part of the global financial system. The inclusion of Robinhood markets in the S&P 500 is a direct result of its profitability from digital asset trading. At the same time, companies like MicroStrategy are actively expanding their balance sheets with new purchases of Bitcoin, with the latest acquisition of 1,955 BTC at an average price of $111,196, bringing its total holdings to over 638,000 BTC, valued at roughly $71.5 billion. This direct corporate involvement, alongside regulatory developments such as Nasdaq preparing to launch tokenized securities, demonstrates a systemic shift. The market is not just trading crypto, it is integrating it. This is a powerful, long-term trend that transcends daily fluctuations and suggests a future where digital assets are a permanent fixture of global finance. Conclusion. The market's performance over the last 24 hours was not a random or directionless affair, but a calculated movement in anticipation of a pivotal data release. The narrative of the day was centered on the Bureau of Labor Statistics' preliminary benchmark revision, which is expected to confirm a labor market that is significantly softer than previously reported. This new, more accurate picture of a cooling economy provides the Federal Reserve with a clear signal and the potential justification for a more aggressive, dovish shift in monetary policy. This powerful macroeconomic theme overshadowed other significant events. We saw this in the market's relatively muted reaction to the French political crisis, demonstrating that the global narrative of monetary policy is a far more potent driver of sentiment than regional political instability. Similarly, the clear, quantifiable impact of President Trump's tariffs on South Africa contrasts sharply with the strategic, forward-looking response from the BRICS bloc, which is now actively working to build an alternative system that is resilient to such shocks. Finally, the cryptocurrency market's price action, driven by the same macroeconomic factors as traditional assets, and its ongoing integration into legacy financial infrastructure, as seen with Robinhood's S&P 500 inclusion and MicroStrategy's continued buying, confirms its maturation. The market has priced in its premonition. The focus now turns to the official numbers and the subsequent Federal Reserve meeting, which will either validate the market's conviction or introduce a new set of variables. This is not the end of the story, but a new and critical chapter. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.